Thank you. Am I visible? Thank you. Thank you once again, uh, Ankur, for the brilliant report. Uh, it was clearly data packed and very, very interesting to see how large scale changes and trends have been observed across sectors. Thank you once again. And now moving on with our agenda on the panel discussion, 5 big unlocks for greater allocations to India. The year 2021 was dominated by trade tension, sharp shifts in monetary policies, leading to focus on precious metals, ongoing transitions in China, and rebalancing Europe, not to forget COVID. In 2022, we've already seen volatile markets, very volatile markets. Anticipation on when and how much interest rates will increase to the waves created by Russia-Ukraine war and its economic impact. It is anticipated that headwinds from trade shall dissipate while monetary policy will play a balancing act. As a result, we expect economic momentum to improve, with growth returning to trend by the end of 22. Or is it? What does these macro trends imply on capital allocations to emerging markets, and especially India, as it shifts focus from managing fiscal position on 35% increase in capex spending and plans full throttle into an economic supercycle? The panel discusses these key aspects emerging from the macro story for India-focused allocations. With that, let me first introduce you to Siddharth Shah, Senior Partner, Ketan and Company, who will be moderating this session. Divya Sehgal, Partner, True North, Manish Kejriwal, Managing Partner, Kedara Capital, S. Srinivasan, Managing Director, Kotak Alternate Assets, and Sudhir Varia, Managing Director and Deputy CEO, Multiples Alternate Asset Management. Welcome all, and everyone looks forward to your insights. Thank you, and over to you.
Thank you. Thanks, Salka, for the kind introduction. And hello, everyone. Welcome to this session. I'm sure all of us would have loved to be doing it in a more traditional way where we can be out there in person and obviously not to forget the opportunity to interact in person, and obviously free drinks from Rajat would have always added more to it. We will miss it, but hopefully some of us can join in the evening. But definitely it's a wonderful platform, and must congratulate IVCA for really putting this together. And I think the last 2 years have obviously helped us adapt to many new things, and this is again a very good platform which not only helps us interact and have a panel discussion like what we're going to have now, but also guide, I guess, it will become something which will become part of our lives going forward. So obviously, I think I have a great panel here, and I think each of the panelists don't need any further introduction. So I'll jump right into the topic here. What we're going to really cover over the next 45 minutes that we have would be really the number 5 is what we've been told, major unblocks that India should be looking at if they are looking at increased allocation towards this asset class. I mean, I'm sure we've all seen the tremendous growth of this asset class, and for many of us over here as well. Personally, I can say for the last 25 years, you can definitely see the way the asset class has evolved and into something which is today clearly global in many ways. And at the same time, also, if you really look at the amount of capital getting committed, has been increasing manifold. Almost every couple of years, we are multiplied by at least a multiple which is more than 2. And that is really where I think we are now talking about this as an industry. Also, I think clearly from a policymaker perspective, this industry has achieved a recognition as a strategically important industry, and I think that obviously has contributed in a positive policy making as well to a great extent. Within this backdrop, and I think we still feel when we look at India, the question obviously for our panelists here is, are we yet there? And if not, and are we yet there in terms of global allocations compared to maybe some of our peers, or maybe even more developed markets? And if not, then what are few things that we should be doing as an industry and as a policymaker, as an economy, to really get there? And I think, obviously, given time to cover each of these may not always be possible. So we'll try and touch upon the key ones that we think as a panel would be worthwhile for all of you to know. So starting off, I think I'd like to bring in Manish, and I think Manish, you have been, as Kidara has been, obviously been one of the forefront domestic GP, a team-led GP which has been out there in the market and seen a great amount of success in terms of fundraising and getting allocations from global LPs. Do you want to kind of share your thoughts? And then I think it will also serve as a background setting in a way of how you've seen this India as an asset class really evolve in the perception of global LPs. And then maybe we can take it forward from there and get others' perspective as well. Over to you, Manish.
Thanks, Siddharth, and thanks to everyone. Thanks to Rajat, IBC, for having us all here, and having the time to have this discussion. It looks like it's been 2 years, and we've all been cut off from each other. So, as you said, would have been great to do this in person, but in the meantime, this will have to suffice. My thoughts, Siddharth, on this one is relatively straightforward, right? When Roger twisted my arm on this panel, and I saw the title as the five big unblocks for increased allocations to India, frankly, I'm of the belief that even before we look at the further action steps, we should recognize, compared to the time we had, and I'm looking at everyone in this group, we were all around in the after the financial crisis, and we're all about to do fundraisers and build up. As you know, I was earlier at Temasek, and I'll give you the shift we had in our mindset on India. But then, as Kidara, we were fortunate, like Kotak, like Multiples, like True North, to raise a series of successful funds. I think if you had sort of said this was where we would land up in 2009 or 10, when it was a much tougher value proposition, I would be, I at that time wouldn't have estimated any of us to have raised sort of funds that we have from global markets. And as you know, we ourselves from 2013 have raised three funds, one in 2013, another one in 2017, and one last year right in the middle of COVID. But my point is, when I saw this topic of five unblocks, in a sense, the macro as well as India as an option has always. So let me just, for the moment, just set it up by saying, a lot that was done in the last 10 years, whether it's, will soon be the third largest economy in the next 5 or 6 years. We've had so much to do in terms of the economic growth. A lot of the specific steps taken in the last 5 years, whether it was GST, the Monetary Policy Committee, the whole Make in India, the digital infrastructure has grown so dramatically. So, of course, we can discuss those in detail. But I think when we look at India as a investment option, it normally compares to other emerging markets. So I remember in the early days at Temasek in 2003, we actually were selling down developed market positions and buying into emerging Asia, which in that case was very much China and India in that order. We all remember the phrase BRICS, set up by one of our Goldman colleagues many years ago. If you look at BRICS today, I mean, China, there's a pivoting away from China into India. We benefited. Russia, given the recent trends, but even before the recent trends, it's been a huge challenge. Brazil, South Africa, frankly, or even if you look at Turkey, or the only other place, frankly, in the recent past where money has gone in at a macro level has been Indonesia, right? So both China, Russia, Brazil, South Africa, really not options. And China will become even tougher given the position that's been taken. And if you look at specific pools of capital, whether it's Japanese capital, that used to be primarily in China. Given what's gone on from a political situation, that pivot has already happened towards India. The situation in Russia will cause further pivoting away into. So when you look at options as an investor, whether you're a pension fund, you're an endowment, you're a large university endowment or a family office sitting in North America or Europe or Japan or Australia or even the Middle East, there are not many places where, from a risk return perspective, as well as if you're looking at buying into growth, that you would option. So I just wanted to recognize the fact that, in a sense, compared to where Srini, Divya, Sudhir, and I were 10 years ago, the context itself is very different, not only in itself in terms of India and what the government has done in the last 10 years, but also relative to other options that investors have.
Yeah. No, that's well said, Manish. And I think you're right. I think India as an asset class is now duly recognized as an investment. So I think no longer the story of selling India as an asset class is probably needed. I think it's really now the focus on where we take this to the next level, where whether are we getting a fair share of what we should be getting, and I think that probably is where we should be focusing on. So I think, and then again, I don't know, maybe Srini or anyone has any additional perspective to share on this based on their experience.
See,
Yeah, yeah, no.
Quite Steve.
yeah. So, completely agree with Manish that over the last 10 years, there's been a lot that has been done and a lot that has changed. And obviously, capital always chases growth. And this is an economy which is growing, which has done things. And the last 10 years has not been the best of times, given the slowdown in real estate, banking sector NPAs, leverage corporate balance sheet. And we have managed to achieve good growth. We have a fantastic entrepreneurial system. There are entrepreneurs who have built great companies, and all of that has benefited us. But as you said, Siddharth, the question is what takes us to the next step. And there, I would still say a lot of stuff that we can continue to do. There is the perception of India even now when you talk to international investors and when you look at it from an international investor perspective. Is it a while it's a large economy, can it create companies of scale? Is a big question that still comes. It's a big economy which has done very well in the service industry. Is it appropriately innovative enough? Is the R&D, the innovation cycle, where are they on the innovation curve? And that is something which we still have to get our act together. And I would also think that the last point, and I'm sure that a lot of others have points of view, the ease of doing business part in terms of when you talk about it, and again, not to take away from the huge steps that we have taken, but stuff like labor market reforms. Is it easy for a company who has taken the risk and decided to enter India, but probably the risk has not played out and now wants to exit India? Is it easy enough for them to exit? Is enforceability of contracts easy enough? There are several aspects around all of these where we still score low, and it kind of holds us back. Apart from that, many of what we would like to do as private equity can bring the entire spectrum of the private equity playbook to the country. Like for example, taking companies private, we have companies. Can we take them private?
So, sorry to interrupt, and I think each of the points that you are making are relevant points and will serve as some discussion points for the topic. So we'll come to some of these and maybe we can do that. But before we go there, and I'm looking at it a little more macro at this point, and I think while we've seen private equity as an asset class, we have seen within that, I think we are kind of completing the spectrum of capital play, yeah, that's available for global investors. I think credit has been one asset class, which I think we have seen some amount of growth over the last few years, very recent compared to the private equity. And I think clearly globally, if you look at that as an asset class, it's clearly one of the big drivers of allocation across markets. And obviously, India may not have really achieved its fair share to get that allocation. So maybe I think, Srini, I would like to bring you in over there. Do you really see this as one big asset class which can bring in a lot more allocation than what we currently getting for the industry at large?
Thanks, Siddharth. I think the point is absolutely right. We started doing strategies on credit nearly 8 years ago. First, when the government opened up NCD investments for FPI, so we had raised some money offshore, and we were one of the first few private equity players or alternate players, if I can call that, who managed to put in the first few dollars through the FPI structure in credit to solve the liquidity problem in real estate, which is a sector where the domestic banking industry does not really address. Since then, we put out nearly $2 billion of capital in real estate, all credit strategy, and we, as you know, had a $1 billion special situations credit fund. So in aggregate, about nearly $3.5 billion. And all of the capital that we raised were from international institutional investors for this particular strategy. So you open the topic by discussing, what are the five blockages that we need to really look at. And I think, sometimes we in India tend to think about these blockages only from an Indian context. We think the problems that we have, whether it is taxation, whether it is, enforcement of contract, or some of the other points that are only our problems. I think we need to get out of that mindset. The mindset that we need to think about is that what is it that we need to tell the rest of the world as to why this market is attractive and why they need to really pay attention to look at India as an asset class by itself. I think you made a comment that India is an asset class. I don't necessarily agree with you. From an LP allocation point of view, for very large LPs, that is not the experience that I've had. And there are two issues out there. One is a certain branding issue, for example. I think what Multiples or Kedara or True North have done is pioneering effort. They have set up fantastic businesses, Indian-led, Indian-operated entrepreneurial businesses to go out and raise capital from institutional investors. When we go out to raise credit strategies, etc., one of the challenges that firms like even Kotak face is that the investor has a choice of allocating capital to a fund which is India dedicated, which is what we do, versus some global brand name which may say, I have an Asia fund. Doesn't matter if 90% of that Asia fund is going to invest in India. The chances are that they will allocate the capital to the Asia fund, which, by the way, may have only three people on the ground and no real history. So the question is, what are we doing that to break the so-called perception that we know how to do business in India and we've done it well in the past? And that takes a fair amount of our own effort, the whole collective effort of the industry, where to say that, look, you can conduct and run successful businesses, which my colleagues on the panel have shown in the past, and that's what we've been trying to do. The second big point that I would like to really emphasize here is that one of the key challenges that we face, particularly when you talk about credit strategies for international LPs for allocation to capital in India, is the million-dollar question, elephant in the room, which is the currency risk of investing into India. I don't have the data with regard to private equity, but I do have the data with regard to credit, because we have seen four full life cycle funds of capital raising, capital deployment, interest being paid out, principal capital being paid out. Here is an interesting statistic that I want to tell all my panelists and all those who are listening here. The average depreciation of the rupee is about 3.5% per annum. When you do a credit strategy, you call capital at various points in time, you distribute capital also at various points in time, i.e., your capital is coming in at various exchange points and going back at various exchange points. I have empirical evidence to prove that the net dollar impact in terms of the LP's return is impacted by exactly half the depreciation rate. So if it's 3.5%, roughly the depreciation loss for the LP is 1.75%. So we need to be able to talk about this kind of data points what exactly is the currency risk that the LP is taking when they look at investing in India. And the third and final point that I would like to make is that it is time that we as an industry continue to have pushback on dollar hurdles. I mean, all of us obviously are working on the holy grail of carried interest. Now, if, and this is a conversation I've had with a number of LPs, and the conversation goes as follows: if the LP has decided to allocate capital to India from his global capital allocation matrix, I'm sure somebody has said we will put X percent in India. That's why he's talking to you. That X percent has been arrived at after taking into account the emerging market and currency risk. Please don't transfer the currency risk to the GP. And that is a pushback that we have been able to translate into every fund that we have raised. We do not have a single international LP fund with a dollar hurdle. We just don't take it. And I would encourage every one of the panelists here, as well as others who are listening, we must push back and put at dollar rupee hurdles. Once you have rupee hurdles, you can then combine the other big elephant, which is domestic capital and international capital, and you don't go through complications of calculation of hurdle, carry, etc., etc. So we need to do a lot more work to really sell ourselves very hard to the LP community and really ignore the glitches of GST and other stuff. Let's focus on what is it that we can tell the LPs. I mean, think about China. In China, if you're a foreign investor, the regulator decides whether they like your face or not and decides to give you an approval whether you can take the money out of the country or not. What worse can be that compared to what we do in India, which is rule based? So I think we sometimes trash the rules in India much more than it deserves to be.
Well said, Srini. I think very, very typical Srini on voicing his views. But no, definitely, I think very interesting perspective. And I think the image building that we need to do, I mean, our wish list as an industry on the legal, regulatory, tax may not be very different from maybe many other markets. But I think really positioning the asset class right to the global LP is definitely an area that I think as an industry we need to kind of work on. And again, a very important point on the dollar hurdle. I don't know. I mean, I'm sure our panelists here will have views, and some of them may definitely agree or disagree with that. But definitely an area that I think we should focus on. Uh, I think, Sudhir, you also have been looking at credit strategy, and equally so, I think Divya as well, True North has also been kind of looking at expanding the offerings around on the credit strategy front. I mean, any thoughts on that? Do you think that's an asset class which can really bring in a significant increment in the asset allocation, global asset allocations for India?
Divya,
Sure. There's a couple of comments on credit strategy. I mean, if you look at it on any cap table, right, for a growth country like us, you could argue that in fullness of time, the amount of credit it will consume will be a multiple of equity, right? So literally for most alternate asset players, as we all are building our respective firms out, one could argue that the alternate credit strategy should be a good multiple of what we deploy on the private equity side. And one of the reasons why I'm adding to one of the point to which Shini said why that has historically been a challenge, at least to my experience, is that the delta after accounting for tax and depreciation, the net dollar that is delivered in, say, high yield performing debt in India is not a material delta over what it would be for high yield performing debt in the US. And that at a 200, 250, 300 bips does not account for the liquidity or the emerging market risk for many of the global LPs. Now, how do you solve for that? We can come to it when it comes to the tax part of the conversation. But that is a clear potential issue right out there. Now, I will say that one of the things which has been positive, going back to Manish's opening comment and also what Shri was saying, is that the domestic pool of capital is truly deepening. Right now, we have LPs domestically who are running an AUM of 25 to 30 billion dollars. Not obviously, mostly 95% not in alternate assets, but those are the kind of AUMs that many of them are running. And those are growing at 15%, 20% per annum. And if you add that, that becomes a serious amount of access to capital, which again, both as part of the liberalization journey of our country and deregulation, I think a lot of those pools of capital are opening up for alternate asset strategies. But again, they need to truly deepen if we have to get to that vision on the credit side of credit being a multiple of equity at least, as one thinks. And the last point I'll make on credit is that a lot of long-term credit, actually the best vehicle, at least in our view, to do a lot of long-term credit, which historically sat in a bunch of non-bank lenders. It's actually a little bit of an enigma, right? Why should long-term credit sit on a non-bank lender when eventually the non-bank lenders get their money from banks, for the most part, or capital markets? The best way to do that non-bank, long-term credit is actually through some of the long-term credit funds. And that sort of is a perfect marriage, right?
No, I think very, very interesting points. I think definitely credit is, and then obviously when we come to the legal, regulatory, and tax, we can obviously touch upon things that we need to still work on. I think maybe I just wanted to kind of shift gears a bit to say again, do you really think, and this is for you, Divya, I mean, India, obviously, alternative asset class has been growing, has been kind of continuing to attract global capital. Do you see talent? And I think one of the questions has always been, and whether India is kind of generating enough talent, or at least getting global talents to come in and really build on this asset class further. I mean, I believe you had some thoughts and views around it. Is there something that India can do to kind of meet this side of the asset class?
So, among the classic factors of production, at least in my book, talent comes number one, right? And talent always precedes capital, not the other way around, right? Was at McKinsey when I started there, right? Again, Tino came in 91 or 1989, and then the business followed, right? Some of the founders of True North decided to set up the fund, and then the capital followed, and so on and so forth for everybody's journey. Right now, there is really the key question. Firstly, if you look at what have we achieved in 30 years, I would say clearly, if you look at private equity today, from 20 years ago, the talent pool is deep. People have experience of investing, exiting, is becoming deep. In private credit, obviously there are a few franchises who have done this for a decade or more, but still it is nowhere close to the depth of what private equity has reached, and this is a process, right? So if we have to eventually build deep pools of capital across all alternate asset categories, I think this is something that needs to happen. Now, in order to do that, right, whether we are building our own teams or building teams of our portfolio companies, eventually three things. Opportunity is the first one, which we don't have to discuss, right? It's a given. The second is economics, and really celebrated cases of success, right? Most of us are sons or daughters of capitalism, and there I would say still celebrated cases of success as much. We are hesitant as a country. A little bit we are hesitant as a country. And third is quality of life. So in fact, in my view, a lot of inbound talent coming into India has sort of slowed down in the past few years. Firstly, a lot of it has come in the last 2 decades. But again, the inbound which is very high quality talent coming in with good quality global experience has slowed down a bit, partly. So I think what can be done about some of this. I don't think there is a switch to trigger anything. It's really all the three. It's ease of doing business. It's better quality of life, and it's celebrating successes.
Well said. I think good points, and I think very, very critical factor in any industry, the factors of production, as you rightly said, talent is something which is paramount, and then obviously that needs to be kind of rewarded and attracted. So we have to be a magnet for talent if we were to really grow this asset class to something which is going to compete with maybe other markets. I think also, Sudhir, coming to you again, and I think the point that you touched upon, and I think linking it to what Divya just mentioned, celebrating success. I think for any matured market, and I think where you want to celebrate success, it's also the fact that accepting failures in a business. And I think that's always been one of the questions when you really look at some of the developed markets and other, maybe I don't know whether we can compare it equally with other emerging market. We are already breaking away from thinking ourselves as emerging at all times. Do you think India is really, and the mindset in India is really something that needs to change? And I'm sure it's open for others to contribute as well. But I believe you had some thoughts on that.
Yeah, I guess one of the challenges that we have, and I first of all, I agree with Srini that there is a lot to celebrate for our country, and which is why we are all here, right? We have been raising money and deploying money. But that said, one of the challenges has been it kind of how to deal with businesses in a failure, and whether we look at how closing down of businesses, or when businesses fail, how do we ensure that it gets reorganized? It is either merged, or it is kind of something else happens to it, or debt gets restructured, the IBC process, etc. When businesses fail, the process of reallocation of capital and turning it around is a very cumbersome one in the country. And very often it takes away a lot of energy of the entrepreneur who started it, because he is also responsible for closing it down. And the pain of closing that business is so elongated that it often kind of dissuades other entrepreneurs from entering. And we need to make that process a lot more smoother. And I guess some people like Srini working on the stress assets would agree to it that despite the best of kind of intentions, we have not been able to get our act right. And many of these tie up, right? When we talk about Divya's, the question that Divya was answering about the credit funds, I think one of the challenges that we face in kind of raising credit fund is when companies fail where we have provided credit, what is the recovery? And currently, the experience of saying that recovery rates are, whether it goes through a restructuring process or it goes through a liquidation process, I would say it is less than 50%. And that makes the cost of credit very high. That makes it difficult for us to invest in sectors like, say, manufacturing, where leverage and the cost of leverage becomes key to generate the 20%, 25% equity returns. So there are knock-on effects that come by virtue of all of this. So allowing businesses to kind of, I won't say die, but at least restructure and reorganize capital is very important for us. It's a big unlock as we would call it.
Sure. No, that's well, that's true, and I think we'll come to time permitting. We'll also get Shrini your views on spatial sits, and I know you have some thoughts there. But before that, Manish, I think I wanted to come to you on. I know there. I mean, ESG has been one of the key kind of themes, if you may put it globally, and obviously we've been hearing about it being really the key driver for a lot of institutional capital, and obviously each aspects of ES and G are as critical for sustained and growth for the economy and for the businesses at large. You want to touch upon, I think, whether on those aspects where we stand as an asset class, and are there things that we should be doing or we can do to kind of improve on that count for the country to come up?
Sure, Siddharth. I think if you look at this term, especially over the last 3 years vis-a-vis 10 years, while some people might, say it's a fashionable term created by the Nordics, etc., it's actually now become real. It could potentially be a real hurdle from a country perspective, right? So until there's a perception and optics, and no matter what we say, there will be certain pension plans globally, especially in North America and Europe, which will actually drive allocations or actually restrict allocations if there isn't a certain minimum level of hygiene maintained across environmental, across governance, and other social issues, right? So I think, having said that, it actually is much more applicable at a fund to fund level and a GP level, right? And I think essentially, if we internalize what this means, and in my mind, of course, the governance aspect is what we do as a living when we evaluate. David talked about people and the importance. It's just not people in our teams, it's the people we back, right? You might see the most phenomenal balance sheets or P&L, but if you are not confident in the governance or the quality of the management, in my mind, those are interspersible. You're just not going to invest. So I think on the governance side, if you look at the way each of us behave, no matter how good a company sounds, it goes, if you don't believe in people, the quality of governance, any investment we made in the last 20 years, where the quality of the team or governance was an issue, we ended up failing, right? So I think we need to internalize into our own system. The only place I think, there were specific questions in the last fundraise, especially where we need to tackle, and each one needs to tackle it themselves, is around more and more around gender equality, right? So I'm looking and reflecting, barring a phenomenal introduction by Alka, the five of us happen to be Olsen names, right? So again, this is partly, so we've always, said all else being equal, we would always hire a woman candidate than a man. But there's a certain. So all I'm saying is, going forward, no matter what we think about it individually, the term's going to stick. And as an industry, we need to make sure that there's a certain level of hygiene that we all follow.
Yeah, yeah.
But in
Srini,
my mind, most of us live it already. I would love living, we live it already. So I don't think it shouldn't be seen by any of us as a hurdle. It should just happen naturally. We should internalize it. I don't believe in setting up an ESG committee per se to follow or dot the I's and cross the T's. We need to actually internalize and believe in this.
yeah, no, I hear you, Manish, and I think definitely it's more important to internalize it. But I'm saying, coming back to the point that we need to be able to sell the concept as well to the LPs. And I do think we as an industry, as an asset class, when it comes to ESG, have we one internalized it enough? And second, if we have we really projected it out to the global LPs? Because I still see that it's ESG is being talked about, but when it comes to real, whether pitching it to the LPs or whether it's really practicing it, we I'm not sure where we stand as an industry. So I mean, I don't know if Srini, Divya, Sudhir, any of you have a view otherwise as well. But would love to get that thought.
See, from our perspective,
Yeah,
sorry, go ahead,
Srini.
Divya.
Well,
Go ahead, Divya.
Go ahead, Srini, please.
See, from our perspective, what we have done is that, first of all, I mean, as a larger conglomerate, our ESG positions is already in public domain. I mean, we have a lot of businesses because thanks to the fact that one of the earliest investors that we had in our first few funds was actually CDC. So the inculcation of ESG as a practice got introduced even at that stage. And from a, and I'm say I can say, first of all, I'm pretty proud of the fact. A couple of things I'm proud of the fact. First, I think to Manish's point, Sudhir is representing a firm led by I would say the queen bee of private equity in India, and nothing can be a better example of one of our colleagues being so successful. Second is that the person who actually raises all capital for me is a lady, and I don't know whether she's on this. Snigdha is her name, and I dare all of you not to poach her, but she has been one of the key reasons why we've been successful in raising capital as well. So I think you're right. I mean, it takes time to integrate this, internalize it. But if you bring it from top down, and if they see that the leadership is focused on making sure that you get the right balance between commercial returns and the kind of governance that you expect from the companies, I think it's implementable. We've been able to implement it in such a large group of ours with nearly 65,000 employees. I'm pretty sure we can do it in portfolio companies as well as our own asset management firms.
Great. Okay, I know Divya, you had some thoughts, but I'm also mindful of the time, and we want to make sure that we are not eating into the other panels' time as well. But just I know regulatory tax certainty, and I think that I would say any LP when they're looking at allocations globally. I mean, one is to assess a good and a bad is easy from a jurisdictional analysis. Where they obviously kind of cringe the most is where there is uncertainty. And then that's obviously one of the factors that kind of clearly, however good you are, but you are not able to kind of give them that comfort that the regime is certain, the tax or regulatory regime is as good. Where do we rank on that? And I think we've obviously have seen a fair bit of change, and I think we are relative to many other markets, we are very young. So obviously, there's bound to be evolution of each of these aspects as the market matures. But do you think there's something that we can do, and I think, or the policymakers should be looking at as an approach which can help kind of allay some of these fears for the global LPs when they look at allocations from a long-term perspective? Maybe we'll go around the table and maybe we'll start off with you, Divya. And then
I think perhaps the topmost requirement on that is to have a predictable and time-bound regulatory regime approval process, right? And I would say in parts we have achieved that maturity and we are materially ahead. And let's take the capital market, going public process, so filing a DLHP with SEBI. That's a fairly now well-defined, mature, time-bound process, right? So that's something compared to where one could have been, say, a decade and a half ago. That's the good news. Now the question is, can we replicate that, right? Tomorrow we are selling an insurance company, we're buying an insurance company, right? Or timelines like this, right? How can we find a way to have a certain predictable and time-bound process for that? Is that achievable? Now, I do recognize that many of the regulators and they work with each other and work with many other authorities to give approvals and or ask for changes. But that sort of, at least to us, is one of the areas where if we can find a way to reduce friction, then it can actually enable, because remember, we as an industry, time is our enemy, right? Uh, and eventually, that's what many of us are solving for. The second one, where actually I don't have great ideas, but the only thought I can place on the table is that faster dispute resolution. That's so critical. Maybe we just build out an outstanding arbitration process, at least for commercial disputes, that issues can get sorted out, say in a 6 9 month process than years. Now, this of course is a bucket list item for our country from many years. So this is not going to happen soon enough. But this, to my mind, stays one of the critical factors which can actually improve a lot of our capital deployment and capital exits.
Manish, you want to go next?
On this, what I would say is we need a consistency, right, on the entire tax policy, and it's just the clarity of regulations, right? And I think especially as we're starting new jurisdictions like Gift City, I mean the list can be endless, but I think the one or two areas to focus on that is just clarity on rules around things like substance, right? So Singapore, for example, is a jurisdiction which says if you invest and have an expense of X number of dollars, I think it's $250,000, and a certain number of manpower. That is what presence is, right? That's substances. In the absence of that, you can have a poem issue and the like, right? So, one, providing that clarity is useful, and then secondly, just having a longer term aspect to that rather than ticking and tacking and tweaking one rule or the other will give much more confidence. I mean, of course, the GPs, but even as the GPs, the confidence of the LPs would also fall from that perspective, right? So if you want to make stuff like Give City a far more attractive, and they've done a lot, I must say, in the last few years, not just for the GPs, but also for the LPs, right? So then you don't need any tax filings, etc. if you do that, versus in a domestic fund, yada, yada, yada. But I just think at an overall level, consistency and then just more clarity would be extremely useful.
Sudeep?
Yeah, echo all of that. I think one of the things that we need to, as a mindset, is to say that we normally come up with regulations and then we kind of try to think of how can the regulation be misused and then we make it more and more and more complex. And then we reach a point that it becomes unimplementable. We need to kind of say that attracting capital, there is a collective good that it serves of taking our economy to the next level, and there is a bigger purpose that it serves. It doesn't matter if there is someone will misuse in this particular case and reduce the regulation to address that lowest common denominator. We need to keep it at a big level, have simple policies, good clarity, implementation at a large stage, and that spirit. For example, again, the point that that I made earlier in terms of if you look at this taking private. Now, obviously, we are trying to address the needs of that one minority investor and ensure that his interest is fully protected. Now, to do that, we make it so complex that this taking private doesn't happen at all. And many companies which would have kind of benefited by going private and with capital investments and which would have unlocked potential into the economy, that is not served. So we need to think and because in any democracy it becomes more difficult because it's a collective decision making and there are always this small group of people who will point out circumstances in which it can be misused. But somehow we need to be able to raise the level of debate, and that's easier said than done, but that's what's required.
Great. And back to you, Shrini. I think.
Look, I think everybody has said all the issues that plague our system. I'm quite hopeful in the statement that the finance minister had made that they will form a comprehensive committee to uh, overhaul the entire set of regulations, be it SEBI regulations, tax, or otherwise for this. So I do hope that we are able to finally get what we are really looking for with regard to a integrated regulatory environment between tax and regulations, which will make our this industry grow from where it is to where it ought to be.
Yeah.
Because if you look at uh, you know uh, investment bankers, for example, they successfully lobbied to change the rules of the game to have loss-making companies going public,
Yeah.
and or a rule that was in place for nearly 20 years. They successfully lobbied to change the way disclosures will be made in prospectuses to make these companies public. So it's just the ability to get your voice heard and get the job done. And I think collectively we are now getting there because this for the first time that we're going to mention in the budget that will be a committee to look at the issues comprehensively. So I'm pretty hopeful
Yeah.
that finally sort of got that critical mass to get things done.
No, I think I cannot agree more with you, Shrini. And I think I think also at times as an industry, our wish list has to be endless. So I mean, I don't think there should be any hesitancy on putting the wish list out. But we also need to recognize that we are still relatively nascent and we are still in our teenage, if I may put it. We've grown from infancy to a teenage when you compare to some of the developed markets. And obviously, the level of evolution and understanding amongst the policymaker is still kind of improving. And we've come a long way. If you may look at it, I think the growth of the asset class, I would say one strong factor has been an open architecture alternative investment fund regime. And we have seen the success of it. Consultative approach of the regulators. We are seeing, and many of us on panels and how the engagement by the regulators in forming new regulations or policies and addressing their concerns. I think we are getting there, and I definitely would acknowledge all of that. But yes, I think there are things that we need to address on tax or on regulatory side, and I think the recognition has to be there that this is an industry which is doing good for the economy and strategically important, and that recognition in the budget is definitely going to go a long way, I hope, in creating an environment that addresses some of these issues. Yeah, Srini, you had a point.
Yeah, I want to make sure that we in industry must remind the government at this time when foreign portfolio investors have pulled out billions of dollars in a matter of a few days, how much money has been invested by our industry, which has raised money globally and invested into the country, locked in for periods of 3 to 5 years' time.
Yeah.
Please remember that the gyrations of the stock market makes the FPI industry heard louder in the government than us, whose capital does not have the same impact on the day-to-day indices. But every time something like this happens, and it's easy to press a button and take the money out of the country. What we do is far more difficult, and that needs to be highlighted. And there is no better time than now when money is being pulled out by FPIs.
Absolutely well said, I think. And the strategic nature, and I can tell you, at least based on my engagements with policymakers, clear recognition of AIF as a strategic tool by the government is very evident. And I think where you see new classes of AIFs being introduced, policy changes to make that regime far more flexible, a lot of that is also driven by the fact that they see this in a very different perspective. And I think we will hope that it will give us the platform. And I think, as you rightly said, recognition to kind of move to the next level of, and then kind of more importantly, address the challenges around uncertainty. And that is probably where I think we may have run out of time. But I mean, I think I just wanted to quickly conclude and thank each of the panelists here. I mean, I think we've tried to cover some of the major unblocks. I mean, may not have been limited to five, but things right ranging from talent to ESG to credit as an asset class, of course, ease of doing business. A lot of takeaways, as I would look at it, for us as an industry, and obviously for the participants here and policymakers to kind of see how we can all kind of work collaboratively to see how we can take the industry to the next level when it, and then obviously the 5 trillion economy that we do, we will be a very, very integral part, and we are a very, very front runner in trying to achieve that for the economy. So with that, I also wanted to kind of see if there are any questions. I can see a few on the sidebar as more observations, but just to kind of pick a couple of those up, I think, Srini, to your point, and I think that's been well received, that at times we've not been marketing the good that the industry, and I think as GPs, that's one area there, I think, where we need to really go out with one voice and then obviously position ourselves. So definitely that's one of the recognition that there are success stories. Equally, I think about the failure again. There's it's something where as an industry we need to, and an economy need to recognize that. But any concluding comments from any of you before we kind of hand it back to Alka? And I guess
All I would say, Siddharth, is thanks. And I'll say that we've talked a lot about ESG, tax, regulatory, etc., etc. But as I'm sure Srini and Sudhir and Divya will agree, eventually to unblock it, the answer is DPI. As far as we keep performing and returning capital in many multiples of what we take in, that is what will finally unlock and unblock capital flows into India.
absolutely well said and well summarized the last 50 minutes of discussion. I think thanks for doing that, Manish. Over to you, Alka. I think I hope we have kept to the timeline for for the panel.
Thank you, Siddharth.
Yeah.
Thank you,
Thank you,
Siddharth.
everyone. Thank you, everyone.
And
Thank you.
Thank you. Thank you. That was a wonderful, engaging session. Thank you, Siddharth Shah, for moderating it so well, and all the panelists for sharing your candid views.